Hey everyone, Bill Lethman here with Money Evolution. In this video, I'm going to be talking about inherited IRA accounts and what the different options are if you're inheriting an IRA. As many of you know, something called the Secure Act 2.0 just passed in December of 2022. So we've got a few changes to how these inherited IRA accounts work. And it's going to depend whether or not you're a spouse inheriting an IRA or whether you're a non-spouse inheriting an IRA, or if this inherited IRA is going to be part of an entity like a trust. And there's going to be some different options in each one of those different situations. So if you're in this situation, I think you're going to find this video helpful. But even if you're not, even if you're doing some general retirement planning or financial planning, I think this is going to be a very important video for you to watch as well, because it's important as you're doing some of that long-term planning and really some of the legacy planning to understand how your beneficiaries are going to be able to treat your IRA assets should something happen to you at some point. But real quick though, before we get into the content of today's video, if you're watching this and you want to learn a little bit more about what we do at Money Evolution, we have some links down in the description below. We have our Wealth Vision Comprehensive Financial Plan. You can also learn about that at wealthvisionplan.com. And we also have our retirement planning course, which is going to get into a lot of detail on a lot of these different topics. So you can check out both of those links down below, and we'll get into the content of today's video. Okay, now the rules for inherited IRA accounts are going to depend on who that beneficiary is that's actually inheriting those IRA account assets. And there's going to be different options that are going to apply or be available to different types of beneficiaries. Let's start off and talk about a spouse. And a spouse is going to have a couple of different options available to them. And in particular, they're going to have one option that's going to be available to a spouse inheriting an IRA account that's not going to be available to any other type of beneficiary. And that's that a spouse can actually take their spouse's IRA account and roll it over into their own and essentially treat it as if it had always been their account. And the rules for required minimum distributions, for example, or the 59 and a half age, it's all going to be based off of their age, not their deceased spouse's age. And for a lot of people, that's probably going to be the preferred way to go. But there's going to be a couple of situations that you might want to think about where you may not want to roll over a deceased spouse's IRA account into the survivor spouse's IRA account. And one of those is that, let's say that the surviving spouse is not 59 and a half yet. So if that were the situation, you may want to think about what assets are available to that spouse for living expenses and maintaining their cash flow and everything in that time period between their current age and when they're going to be eligible at 59 and a half to take normal distributions from a retirement account. And if that's a longer period of time and there's not enough assets, what you could do is you could set up a beneficiary IRA account. And what that would allow that surviving spouse to do is take penalty-free withdrawals from that IRA account and not be subject to that 10% penalty. So that's one example of why a spouse may want to set that up as a beneficiary IRA account as opposed to rolling it over in to their own. Now, another reason why a spouse may not want to roll over their deceased spouse's IRA account assets into their own is if, let's say, the surviving spouse is older than the deceased spouse. One advantage of having that set up as a beneficiary IRA account is that you would then be able to delay taking required minimum distributions until the year when your deceased spouse would have been required to take their required minimum distributions. So depending on ages and things like that, that could give you a few more years. It could give you, if you've got a big age discrepancy, several years where you would be able to postpone taking those required minimum distributions. And again, this would be kind of planned out within the context of a comprehensive financial plan, understanding what the tax ramifications are of taking or delaying those RMDs, how it fits into all the other moving pieces of your retirement plan. That's obviously something we do with our clients in the Wealth Vision Financial Plan to really help map that out and see what is that doing to the short and the long-term tax implications of that. Now, one other option that's going to be available to a spouse as it relates to an inherited IRA account is going to be to set up a beneficiary IRA account, but then instead of either locking it into your spouse's RMD schedule, or if you were to convert it to your own IRA account, getting locked into your RMD schedule, is having that beneficiary IRA account set up on the 10-year rule. And so that 10-year rule may give you a little bit more flexibility if you're trying to time some income related to what your tax situation may be be, let's say you're still working and you're still at a very high level of income. So maybe taking some of those RMDs isn't the most advantageous thing. Maybe it's going to push you up into too high of a tax bracket. So the 10-year rule basically says that you can take out whatever distributions you want each year, just as long as that IRA account is going to be completely depleted by the end of the 10th year. So again, as you're doing some of the planning, that's something that may be useful if you're trying to time some of that income. Maybe you've got some irregularities with some business income, or you're still working and you want to maybe wait a few years when you may be in a lower income tax bracket. So basically, those are the options. You can roll it over into your own IRA account, treat it like your own. You could set up as a beneficiary IRA account. That could give you some advantages there if you're either not yet 59 and a half, or you are older than your spouse and you want to delay taking those RMDs. And then finally, for a spouse, you can set it up and do that 10-year rule option on a beneficiary IRA account. Okay, so now let's talk about non-spouse beneficiaries and what are their options when it comes to inherited IRA accounts. And this is where there's been a couple of changes here over the last couple of years, both initially with the Secure Act 1.0 and then some legislation that was passed in February of 2022, and then most recently the Secure Act 2.0 that was just passed at the end of 2022. So first and foremost, the biggest difference between a non-spouse and a spouse is, again, it's that ability that a spouse has to roll that IRA account over into their own, treat it like it was always theirs. That, of course, is not an option for a non-spouse beneficiary. So now with the Secure Act 1.0, now that changed the landscape from what was known previously as a stretch IRA account, where a non-spouse beneficiary had the ability to kind of stretch out that IRA account over their lifetime using their life expectancy table. So if somebody was relatively young, their 20s or 30s or 40s, they could have, 40 or 50 years or longer to continue getting that tax-deferred growth on that IRA account and just take out those minimum distributions every year. So that was a big advantage. So with Secure Act 1.0, they shortened that from basically a lifespan to now those non-spouse beneficiaries have to take the IRA account out over a 10-year period. And again, just kind of like what we were talking about with the spouse and their 10-year rule, the non-spouse beneficiaries basically have the same options. It doesn't matter how much you take out each year, as long as that account is going to be depleted by the end of the 10th year. Now, the exception to this is that if the account owner that passed away was already taking their required minimum distributions, then as that money goes to that non-spouse beneficiary in the form of an inherited IRA account, that non-spouse beneficiary is also going to be required to take required minimum distributions in years 1 through 9, and then have that account fully liquidated by the end of the 10th year. Those required minimum distributions are going to be based off of the life expectancy of that non-spouse beneficiary. So now that rule that's now requiring those non-spouse beneficiaries to take RMDs if the original account owner passed away while they were taking RMDs, that's something relatively new. That came in with that legislation in February of 2022. So be sure if you fall into that situation that you're aware of how that rule actually works. So now effectively what all of this new legislation has done is it's made essentially that ability to stretch out those IRA account assets over a lifetime, especially if that lifetime may be that of a grandchild that may have 50, 60, 70 years of life expectancy, and they've drastically reduced that. For most non-spouse beneficiaries, it's going to be to that 10-year window or less. But there are still a couple of classes of individuals as beneficiaries that would still be qualified to get that stretch out. And that's going to be spouses. We talked about that. They're the only ones that really have that long-term ability to do that. Anybody that's disabled, they're going to have that ability to stretch out those IRA account assets. Minor children, this is children of the actual decedent that passed away, not grandchildren, but minor children would be able to use a stretch out option until they're 21, and then they would go on that 10-year schedule after that. So it's still reduced drastically. Anybody that's chronically ill, classified as that. And then we're going to talk about trusts here in just a second, but certain types of trusts may also be eligible for this stretch out, mainly if it's a special needs trust. So in other words, if the beneficiary of the trust is a special needs individual that does have one of these chronic illnesses or permanent disability, they also may have that ability to stretch out those IRA account assets. And if you think you fall into that situation, be sure to check out some professional guidance on that, a CPA or a financial advisor that might be able to guide you in the right direction on that. So now the last thing I want to talk about here as it relates to inherited IRA accounts is naming a trust as a beneficiary of an IRA or having a trust as a beneficiary of an IRA account, and how does that work exactly? And I think it's very important if you are naming a trust as a beneficiary that you really understand all the rules for that. Make sure you've talked to your estate planning attorney, your CPA, or your financial advisor, and you really kind of understand what's going to happen if you do pass away or when you pass away to those assets, and how do those rules kind of get implicated there and everything. Number one is that you want to make sure that your trust has a see-through or look-through provision. In other words, that there's clear and defined beneficiaries of that trust. So they're real people, not entities, and that way you can still qualify for some of these 10-year rules, or depending on what the beneficiary rules are for that, you can still kind of look through the trust to be able to take advantage of some type of a stretch, maybe over that 10-year period or whatever that may be. The other thing too is if that is going to get designated as a trust, you want to be aware, is it an accumulation trust or is it a conduit trust? So accumulation trusts are basically where the income kind of builds up inside the trust. And one very important thing there is if that's the case, you could end up hitting some very high levels of taxation at relatively low levels of income. I think it's like $14,500. You're already in the 37% tax bracket. So obviously that's probably not what most people would want to see. So as long as that trust is going to be passing that income onto the beneficiaries through those required minimum distributions or distributions, whatever they may be, then you're going to be able to keep that at the individual's tax rate as opposed to a trust tax rate. So that's going to be very important to understand how that works. But anyway, if you are in that situation where you're naming a trust or thinking about naming a trust as a beneficiary, understand that it does add an additional layer of complexity that you should definitely seek out some professional guidance on to make sure you understand how exactly that's going to work. So anyway, so that's it for inherited IRA accounts. I know there's a lot there, a lot of new changes. And again, if you like the video, like what we're doing here, be sure to hit that like and subscribe button. Check out some of the other videos on the channel. We are posting on a pretty regular basis right now, so we're trying to come out with a lot of new content. And if you haven't already, check out our website at moneyevolution.com and some of the links down in the description, our comprehensive financial plan called Wealth Vision and our retirement planning course. So anyway, with that, I look forward to seeing you back in one of our next videos. Thanks.